Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Johnson & Johnson stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 442 billion market cap. They're trading at $170 a share and they have 2.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had over 20 billion of free cash flow in 2020. It is going down. It's down to 16 billion. But still, 16 billion is a huge amount of free cash flow. That's the cash that's remaining for you, the investor, so they can pay a dividend, buy back stock, or invest back into the business to grow it. Net income is the profit or loss on the income statement. It's revenue minus expenses. That peaks in 2021 at 21 billion. It is down to 13 billion in the trailing 12 months. Revenue is a sales for the company, and that goes up each year from 83 billion up to 98 billion. They should generate 100 billion of revenue for the full year 2023. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 540 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $490 billion. We divide that by 2.6 billion shares. And we get a calculated stock price of 189. They're trading at 170, so they're trading at a 10% discount. It's a buy according to the model. I did buy a lot of the stock in January 2022. And by the end of 2022, I was up 10-15%, which was really good because a lot of stocks went down in 2022. But this stock has really struggled in 2023. Fortunately, it did go up a good amount when they released earnings last week. There are 17 companies in the same industry as JNJ, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx. Only Merck spends more. A good debt to equity ratio, 0.7. So for every dollar of equity, they have 70 cents of debt. The average is 1.7. The median is 0.8. Look at Amgen, 11.5. They're really leveraged. That means for every dollar of equity, they have $11.50 of debt. If you like dividend-paying stocks, then investing in this industry makes sense because lots of companies pay a good dividend in this industry. JNJ pays 2.8%, which is higher than the average but lower than the median. AbbVie pays over 4%. GSK, GlaxoSmithKline, pays 4.3%. Pfizer, 4.4%. Organon, 4.1%. Lots of big dividend-paying stocks. They generate 16 billion of free cash flow. Look at AbbVie, 23 billion. Pfizer, 20 billion. I also own Pfizer stock, and that's down quite a bit. I think maybe I'm up 5 or 10% on that stock. But at one point, a couple years ago, I was up 50%. 10 of the 17 companies in this industry have a market cap above 100 billion. Lots of really big companies. J&J is the biggest at 440 billion. J&J's price multiples are worse than the median in every category. But their price to book is much better than the average. PE is a little worse than the average. Price to free cash flow is worse than the average. Their price to sales is between the median and average. And they generate the most revenue in this industry. Pfizer is second at 92 billion. Eli Lilly is only 28 billion, but their market cap is over 400 billion. That's why their price to sales looks pretty weak at close to 15. J&J is not growing that much anymore. Their 5-year annual revenue growth rate is only 4%. Look at Bristol Myers Squibb, 17%. They're growing a lot. So is AstraZeneca, 15%, and AbbVie, 14%. Eli Lilly, only 7%. I wonder why the stock is going up so much. They released their second quarter earnings last week. They beat revenue by 3.5%. They beat earnings by 7%. Their expected earnings was 262. They reported 280. Their expected revenue was 24.7 billion. They reported 25.5 billion. They should report their third quarter earnings on my birthday, October 17th. For the first quarter, they also beat earnings and revenue. In the fourth quarter of 2022, they missed revenue, beat earnings. In the third quarter of 2022, they beat earnings and revenue. Let's take a look at their second quarter press release. They had second quarter sales growth of 6.3%. It was 25.5 billion for the quarter. EPS of $1.96, increasing 8.9%. They plan to spin off Kenvue shares through an exchange offer. JNJ owns 90% of Kenvue. Their revenue for the second quarter was $25.5 billion. In the second quarter of 2022 was $24 billion. That's an increase of 6.3%. Earnings increased 6.9%. They reported $5.1 billion for the second quarter, compared to $4.8 billion last year. EPS went up 9%. Of the $25 billion of revenue, $13 billion is in the US, $12 billion international. Their US revenue went up 10.2%. International only 2.2%. Foreign exchange rates also play a part in the revenue increase. Total revenue went up 6.3%. Of the $25.5 billion of revenue, consumer health $4 billion, that's up 5.4%. Pharmaceutical $13.7 billion, up 3.1%. MedTech $7.8 billion, that went up the most, almost 13%. The reason MedTech revenue went up so much was driven by electrophysiology products, trauma and orthopedics, wound closure products, biosurgery, and contact lenses. Their consumer health revenue was driven by over-the-counter products. Their big over-the-counter products were Tylenol and Motrin, as well as Imodium. Additional contributors were Neutrogena, the skincare product. Here's a breakdown of their revenue by country. $13 billion in the US, $5.9 billion in Europe, that's down 3.1% from last year. $1.7 billion in the Western Hemisphere, excluding US, that's up 11.5%. Western Hemisphere is North and South America. So a lot of this revenue is Canada and Mexico. Asia Pacific and Africa, that was $4.5 billion, up 6.6%. Here's their income statement for the first two quarters of 2023, $50 billion, compared to the first two quarters of 2022, $47 billion. All the expenses directly related to generating the $50 billion of revenue was $16.7 billion, which is 33% of their revenue. That gives them a gross profit of $34 billion, or gross margins of 67%. Last year was 67.3%. SG&A $13 billion, 25% of their revenue. R&D $7 billion, 15% of their revenue. Other expenses $7 billion, 14% of their revenue. Their operating income is $6 billion, operating margin of 12%. Last year, operating income of $12 billion, operating margin of 25%. The big difference was the $7 billion expense in other income. Their net earnings is $5 billion, net margin of 10%, down from 21% from last year. Their EPS is $1.93. They have 2.6 billion shares outstanding, a little less than last year of 2.669 billion. Their effective tax rate is 16%. Adjusted EPS of $5.48, which is higher than last year of $5.26. Their net earnings is $5.1 billion. Their adjusted earnings is $14.4 billion. Let me show you how they get from $5 billion to $14 billion. So you start with the $5 billion, and then they adjust for non-recurring items. They add back $7 billion of litigation, $2.4 billion of intangibles, and a bunch of other smaller items. They also minus out $2.4 billion for the tax impact on those special items. So that's how they get to the $14.4 billion. They've done 6 stock splits. The first one is in 1970, 53 years ago. They did a 3-for-1. Then in 1981, another 3-for-1. In 89, a 2-for-1. In 92, a 2-for-1. 96, a 2-for-1. And the most recent stock split was 22 years ago in 2001, a 2-for-1. It's interesting that they only do stock splits in May or June. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $24,000 today. That's a 9% annual return, a 141% total return. That's pretty close to the overall market, a 9% annual return. Let's look at the company on Simply Wall Street. The last price is $170, market cap $442 billion, up 6.5% in the past week. They reported strong earnings, but they're down 1.1% in the past year. Let's learn about the company. Johnson & Johnson, with its subsidiaries, researches, develops, manufactures, and sells various products. in the healthcare field worldwide. The company's consumer health segment provides skin health beauty products under the Aveeno, Clean & Clear, Neutrogena, and OGX brands. Baby care products under the Johnson's and Aveeno baby brands. Oral care products under the Listerine brand. Tylenol acetaminophen products. Sudafed cold, flu, and allergy products. Benadryl and Zyrtec allergy products. Motrin ibuprofen products. Nicorette smoking products, and Pepcid acid reflux products. This segment also offers stay-free and carefree sanitary pads, tampons, adhesive bandages under the Band-Aid brand, first aid products under the Neosporin brand. They serve the general public, retail outlets, and distributors. The pharmaceutical segment provides products for rheumatoid arthritis, psoriatic arthritis, inflammatory bowel disease, and psoriasis, HIV/AIDS, mood disorders, neurodegenerative disorders, and schizophrenia, prostate cancer, hematologic malignancies, lung cancer, and bladder cancer, thrombosis, diabetes, and macular degeneration, as well as pulmonary arterial hypertension. This segment serves retailers, wholesalers, distributors, hospitals, and healthcare professionals directly for prescription use. Its MedTech segment offers electrophysiology products to treat cardiovascular diseases, neurovascular care products to treat hemorrhagic and ischemic stroke, orthopedics products in support of hips, knees, trauma, spine, sports, and other, advanced and general surgery solutions that focus on breast aesthetics, ear, nose, and throat procedures, and contact lenses, and ophthalmic technologies related to cataract and laser refractive surgery under the AccuView brand. This segment serves wholesalers, hospitals, and retailers. They were founded way back in 1886 and based in New Brunswick, New Jersey, which is pretty close to Staten Island. They list 4 risks: dividends of 2.8% not well covered, large one-off items impacting financial results. We saw those big litigation charges. Profit margins 13.4%, lower than last year of 19%. Significant insider selling over the last 3 months. This chart shows their stock price dating back to 1990. When you adjust for stock splits, it was under $7. And it looks like it pretty much only goes up. There are dips here and there, but overall it just goes up. It did peak in mid-2022 at 186. So it is down from the peak, but it's just a matter of time till it breaks through its all-time high again. Simply Wall Street's valuation is $231. They say the stock is 26% undervalued. 20 analysts price this stock and the average price target is $181. They say it's 7% undervalued. Their trailing 12-month revenue in 2012 was $66 billion. And it looks like it goes up pretty much every single year. It's getting close to $100 billion. The forecast for 2023 is $99.9 billion. 2024 is $103 billion. 2025, $105.5 billion. The red line is their debt. The blue line is their equity. In 2012, they had a debt of $17 billion, equity of $63 billion. Their debt to equity ratio is 27%. That means their debt is 27% of their equity. But you can see their debt has gone up over the years, while their equity stays fairly steady. Now their debt to equity ratio is 75%. $53 billion of debt, $71 billion of equity. We can look at their cash balance over the years, the green line. It was $20 billion in 2012. It peaked at $43 billion in 2016. It's currently $25 billion, so they keep lots of cash on their balance sheet. Their dividend is 2.8%, industry average 2.5%. Their payout ratio is 91%. They pay out 91% of their earnings in the form of dividends. You can see they raised their dividend each year. In 2012, they were paying $2.44 per share. It goes up every year, $3, $3.50, $4. Now they currently pay $4.76 per share. The forecast is for them to pay $5.23 per share by 2025. You can see their dividend yield is pretty steady. It was 3.5% in 2012. The forecast is 3.1% by 2025. The CEO's salary is $1.5 million, total compensation $13 million. His tenure as CEO is 1.5 years. In the past 12 months, there's been insider buying and selling. A lot of the trades were by BlackRock. Over 5 million shares have been sold in the past year. 1.5 million shares have been purchased. 70% of the company is held by institutions, 30% by the general public. Their biggest shareholder is Vanguard at 9.5%, then BlackRock at 7.75%. They employed 128,000 people in 2012, and it's been going up a little bit over the years. They're currently at 153,000. The ticker trades in a lot of places: New York Stock Exchange, Mexican Bolsa, Deutsche Börse, the Bern Stock Exchange, also known as the Swiss Stock Exchange, the Xetra, Colombia Bolsa, Santiago, EuroTLX, Lima Bolsa, Wiener Börse, that's in Vienna, Bulgaria, Kazakhstan, Santiago, the BATS Europe, Buenos Aires, and Sao Paulo Bolsa. So that's the end of the video. Leave a like, subscribe, or comment below. Thanks for watching.